This is the S&P versus the SILJ, which is the silver miners ETF. And that one looks pretty bearish as
Even
well, which is a bad thing for the S&P.
even more bullish for silver miners.
Yeah, yeah, we've broken like this low here from October last year. And actually, Clive, it's the S&P is lower versus the silver miners than it was when the stock market bottomed in April. So
The
yeah,
silver miners sector is a very tiny sector compared with the gold mining sector. And obviously, the gold mining sector is a very tiny sector compared with even one of the top 10 companies in America.
yeah.
So, if people do start buying the silver miners, that's the one which could really, really go to the moon.
The relationship between silver miners and the broader stock market is quietly sending a powerful signal. While Wall Street remains captivated by mega-cap tech names and indices hovering near highs, beneath the surface, a dramatic divergence is taking shape. When measured against silver mining equities, the S&P 500 is breaking down, a sign that capital is slowly rotating away from overvalued stocks and into one of the most undervalued corners of the market. This shift may look minor now, but history shows such rotations often precede explosive moves in precious metals. MarioInnecco and Clive Thompson, both seasoned market observers, point out that silver miners, represented by the SILJ ETF, are gaining relative strength at the expense of the S&P. The chart has already broken last year's lows, indicating that silver miners are outperforming even as stocks attempt to maintain their ground. That's significant because silver mining is a relatively small sector compared not only to the gold miners, but also minuscule compared to America's corporate giants. If institutional money begins to flow in, even modestly, the upside potential could be extraordinary. Beyond charts, the fundamentals are also supportive. Many miners are generating profits today and could multiply their earnings as silver prices continue to rise. The key, however, lies in picking wisely. Producers with strong balance sheets and scalable reserves are best positioned to benefit, while speculative exploration stories remain risky. Often, the most compelling opportunities come when small profitable miners sit next to larger players seeking expansion, a recipe for acquisitions. This dynamic, combined with the S&P's relative weakness, paints a clear picture. Silver miners may be preparing for a breakout that few are ready for. If you found this analysis helpful, make sure to like this video, subscribe to the channel, and share your thoughts in the comments below.
Clive, I saw this post yesterday by Luke Groman, and it's weird because I never really bothered to compare these two, and I should have. But he says belated Nixon closing the gold window anniversary. So I guess he was about a week late, but it doesn't matter because it's a really good analysis here. So you've got the S&P priced in gold, that's the blue line, and the S&P priced in fiat dollars, the red line, since August 1971 when Nixon closed the gold window. And it's amazing that it shows really that gold is a true, in my opinion, revealer of wealth, because in gold terms, the S&P is down 21. I'm going to increase it here, down 21.08% since 1971. It's not much. I mean, it's been pretty steady. I guess it's been, and if you add the dividends, that's probably done okay. The SPX versus gold. But yeah, in terms of the fiat dollar, though, it's up 339.88%. So I think what it tells us, Clive, is that under a fiat currency system, the people who have wealth, they're going to put it to work. They're not going to leave it in the fiat currency. And unfortunately, the people, the bottom 50%, they're struggling to make ends meet, so they can't save. And they're the ones that are hurt. And I think it's one of the reasons why wealth inequality has gone up so much.
Well, you know what this tells me? If I look at this over the 50 odd years, you've only lost 21% relative to gold in the S&P 500. That's less than a quarter percent a year, probably less than half a percent a year that you've lost. It's almost nothing. So for those who've got the S&P 500, it's not too late. If you've only lost half a percent a year, it's not too late to take a little bit off the table and put it into gold. I mean, okay, it might hurt a little bit to buy gold at a higher price than you could have had it 50 years ago, but the difference isn't that big.
I just want to go back a little bit here on the stock market and the miners. I forgot to show you and the viewers this one. This is the S&P versus the SILJ, which is the silver miners ETF. And that one looks pretty bearish as
Even
well, which is a bad thing for the S&P.
even more bullish for silver miners.
Yeah. We've broken like this low here from October last year. And actually, Clive, it's the S&P is lower versus the silver miners than it was when the stock market bottomed in April this year. So like it was here, and now we're here. So
The
yeah,
silver miners sector is a very tiny sector compared with the gold mining sector. And obviously, the gold mining sector is a very tiny sector compared with even one of the top 10 companies in America.
yeah,
So if people do start buying the silver miners, that's the one which could really, really go to the moon. There are some very exciting silver miners, and the ones I'm looking at are the ones who are making money. They're pulling the silver out of the ground, and they're going to pull more silver out of the ground next year. Now, that's the last bit is the most difficult bit because a lot of them are going to produce less silver next year. But you want to buy ideally the ones which are making a nice profit and will make a lot more profit because they'll have a higher silver price, which we already got now, but it's going up again, and on a higher volume. You want those two things together. What I'm not looking at are the silver prospecting companies, the ones who've got a hole in the ground and a liar sitting at the top, because there's a lot of stories out there about we maybe found a ton of silver, and I've been around the block long enough to know that most of these stories don't actually work out.
yeah,
Even if they do, even if they find the silver, the
yeah,
problem is getting the finance to dig
yeah.
it up, and that can take
But
many, many years.
But yeah, I agree with that. But a lot of times, these junior exploration miners, silver, they are necessary because sometimes the big silver producers they don't have time to do the exploration. So yeah, like you said, many of them will result in nothing, but some of them will find some deposits that could be interesting, and they'll be gobbled up by the bigger companies that are already producing. The other thing, Clive, that I did back in well about 20 years ago, because I started out buying physical, gold coins and silver in '02, '03, and by 2004, 5, I started looking into the miners and I didn't know which one to buy. So I looked at a fund at the time called Tocqueville Fund, a precious metals fund. It was one of the biggest. They didn't have, I don't think, GDX ETF or anything. And I looked at their prospectus. I also think I looked at the Sprott asset management, and it's all public information, and they give you which companies they own, which ones they own the most. So you go through the list and you pick as well, or you also watch Clive's videos and do both, I would say.
Let me just say one of the things I'm really looking for. This is a really hard search, but if you find it, it's the perfect company. What you need to do is find a company which has got a lot of silver in the ground, already digging some of it up, making a profit, but they don't have the money to expand on their much larger reserves. They can only do a certain amount. And here's the important bit, their mine is located very close to another company which is doing the same type of thing, silver or gold mining, which would like to expand its reserves. So you're looking for something, a big company next to a small company. Small company's got the reserves, the big company's got the money. And in that kind of situation, it's almost a no-brainer that the big company has to buy the small one. Now, that's what I'm looking for. I can't guarantee I'm going to find exactly that, but I'm looking for something as close to that as well, because that's a really bullish signal if you can get that.
The spotlight is now firmly on the Federal Reserve and its gathering at Jackson Hole, where Jerome Powell's comments are expected to shape the next phase of policy. Only a week ago, markets were almost certain a rate cut was coming, but after hotter inflation data, those expectations have faded sharply. Current probabilities suggest a growing chance the Fed may hold steady, reflecting investor unease about persistent price pressures and fiscal strains. Political dynamics are complicating matters further. Pressure from the White House to force rate cuts is raising concerns about the Fed's independence, an issue that, in other countries like Turkey, triggered runaway inflation when central banks lost credibility. Meanwhile, bond yields in both the US and the UK are climbing, signaling investors don't buy the narrative that inflation is under control. The risk is clear. Higher yields could destabilize equity markets, which are already stretched by valuation excess. Let's get back to the interview.
Clive, maybe we could switch over to the Fed and also what's happening today at Jackson Hole. And I'll let you talk about it because, yeah, even though, I know what's going on, but I want to
But
have your take on it.
Well, obviously, the big story today will be what happens at Jackson Hole when Chairman Powell speaks at 4 p.m. European time, 3 p.m. your time, Mario. And that will give us the signal as to what's going to happen to the interest rates. Now, the expectation for interest rate cuts a week ago, before the bad inflation news we had out of the United States, was 100% probability of a cut at one point. That since then, that probability of a cut has been falling sharply. I'm just bringing up the FedWatch tool now. There it is. It's on my screen already. It's just dropped. It was about 85% yesterday. It's just dropped to 73.3% probability of a cut. In other words, now 26.7% cut probability there will be no cut. So the probability of no cut is increasing. It's hard to say why, but the other thing is, which is going on, is international investors are starting to examine to what extent the Federal Reserve can remain independent. We mustn't forget what happened to Turkey when the government started to interfere in the central bank and firing governors who didn't reduce interest rates. I mean, we in Turkey we had the interest rate not the interest rate, the inflation rate after that went to 40-odd%, and independent inflation monitors said that the inflation rate, the true inflation rate, was over 100%. Now, if the government takes control of what is supposed to be a sound money central bank, there's no stopping them from basically printing money beyond anything to pay for every bill under the planet. So where are we now? There are 7 governors on the FOMC, on the Federal Reserve. These are the 7 people who vote on interest rates. So at the last meeting, there were 5 governors who voted to keep interest rates where they were. So President Trump doesn't like them, and 2 who were dissenters, the first dissenters in decades. Normally, the whole board is in agreement. These 2 dissenters, Michelle Bowman and Christopher Waller, dissented and were now, in a way, sitting in Trump's camp, calling for a reduction in interest rates because labor numbers were pretty awful. So 2 out of 7 were in favor of a rate cut. 5 out of 7 said keep rates where they were. Since then, we've had one of the people who are in favor of staying where we are, called Adriana Kugler. She unexpectedly resigned 5 months before her term is up. A very unusual thing to do. And her excuse was something along the lines of, I'm going back to academia. You can believe her words or not, but I don't think anybody in their right mind would just resign 5 months before their term is up because they want to go back to academia. It doesn't sound quite right to me. So I think I don't want to say she's pushed, but there's obviously some sort of upset there. I don't know what it is. And now this week, just coming up today, apart from the pressure being put on Trump put by Trump on Chairman Powell, we've had this news about one of the Federal Reserve governors called Miss Lisa, or I don't know if she's Miss or Mrs. Lisa Cook. And basically, President Trump is calling for her resignation over some allegation, which I think might have come out via a tweet. At least she says it was just a tweet by somebody, about whether she did or didn't claim a house was her principal private residence when applying for a mortgage.
Yeah, Clive, can I just interrupt slightly? You said that lady Kugler resigned, and she voted to keep rates unchanged. But now Trump nominated Stephen Mirren, who worked
Exactly.
at Council of Economic Advisors, and his big thing is to have a weaker dollar and a Mar-a-Lago summit to rearrange.
Yep.
Yeah. So he's going to vote for a cut. So if
So
they
that's
can get Cook,
three out of seven.
so if they can get Cook out, they're going to get 4 out of 3.
4 out of 7,
But
exactly.
4 out of 7, sorry. But you also have there are other voters though. There are another 5 voters from the regional banks, right? They alternate. Not all 12 heads of the regional banks vote. So I don't know how those are voted last time, but I think if the board was in favor of a cut, it would be very difficult for the regional banks to not go along with
I
it.
mean, if obviously Lisa Cook has said she is not going to be bullied by
Yeah,
these threats, so she says she's not going to resign. But let's wait and see. Let's suppose that she now feels that she's under pressure to support an interest rate cut, because that will take the pressure from President Trump off, or take the focus away from her, perhaps. I don't know. I don't think, she's saying the right words, that she's not going to be bullied into anything, and that's the right thing to say. But obviously the pressure is on the entire board to fall into the Trump camp, and basically what Mr. Trump would like would be the Federal Reserve to cut rates and cut it multiple times and by a lot.
yeah, and yeah, they're probably looking into all the other governors, their activities in the last 25 years, what they've been doing, trying to find dirt on them. But Clive, the other what did I want to show you? Oh yeah, the bond market, because you noted that the inflation numbers in the US weren't good, but also in the UK a couple of days ago, we had CPI was a lot higher, well, was higher than expected, and the RPI as well is approaching 5%. And in the past, if that were happening, the Bank of England wouldn't be cutting rates like they did recently. They'd be either keeping them unchanged or raising them. And the UK bond market, I'm going to bring it up here this morning, what it's doing. Okay, 10-year gilt yield. Well, the Bloomberg says 474.
Okay.
So and
The
five.
one, the one it's possible the one I was looking at might have been a little bit out of date.
Yeah.
It was coming from Market Screener.
Yeah, but even in
From
the US, Clive, uh, yields are also creeping up. We're back at like 433 in the 10-year, and we're approaching 5% in the 30-year, and it's still very stable. But if we start seeing these yields spike, this could be also the trigger for a correction in the stock market. I think the 30-year, the key level is just above 5%, around 506, 510. And yeah, keep an eye on these. And it's weird, Clive, because not weird, but it shows that investors are not convinced about inflation. I don't know if you saw earlier this week, there was consumer confidence or one of the surveys, maybe it was last week, the Michigan sentiment and the inflation expectations for 5 years forward was like almost 5%.
I mean, it should be obvious to anybody that if you buy a bond which matures in 10 years or more, what you'll be able to buy with that bond when it matures assuming it matures at all, will not give you, will not be as much as you can buy with it today. So whether we're talking about housing or old care in your old age, or going on a cruise, or gold or stocks, it doesn't really matter, or a fine painting, all of these things, in terms of what it will buy, it won't buy as much in 10 years' time as it buys today. And of course, there's a lot of things which might go terribly, terribly wrong in the next 10 years, which might mean you actually end up with virtually nothing for your 10-year bond. It might be a defunct currency.
What becomes clear from these discussions is that the U.S. financial system is approaching a breaking point. The combination of mounting deficits, inflation that refuses to fade, and political pressure on the Federal Reserve paints a picture of fragility rather than strength. On one side, policymakers are quietly exploring extraordinary measures, such as revaluing gold on the Treasury's balance sheet or experimenting with gold-backed bonds to regain credibility in long-term debt markets. On the other side, the Fed faces a credibility crisis as it balances inflation data against political interference, with Jackson Hole becoming a stage for theater rather than sound policy. For investors, the signals are impossible to ignore. Rising bond yields, strained fiscal accounts, and even talk of tariffs on gold reveal how desperate the policy environment has become. Precious metals, once considered old-fashioned, are regaining their central role as the ultimate hedge. Gold and silver are not just hedges against inflation, they are defenses against systemic risk and political mismanagement. The fact that central banks around the world continue to accumulate bullion while scaling back on Treasury securities should serve as a loud warning. As history has shown, moments like this often define the next decade of capital flows. Whether through revaluation, stealth policy maneuvers, or outright crisis, the dollar's role is shifting, and metals stand to benefit most. If you found this breakdown valuable, make sure to hit the like button, subscribe to the channel, and turn on notifications so you don't miss our upcoming deep dives. Thank you for watching, and see you in the following video.